Question 71. Capital provided by venture capital funds to companies that are prepared to go public and that represents a bridge between the expanding company and the IPO is known as A. Early stage venture capital. So the key here is we're prepared to go public and we're looking to expand the company and do that IPO. That's going to be far after the early stage. Early stage is going to be, when they're looking for capital at the very beginning, maybe very little to no revenue, but they're going to have substantial revenue if they're going public. B, expansion venture capital. So this is going to be utilized to expand the company. And if we're preparing to go public, it says we're expanding the company, but this is still going to be earlier on in the life cycle of the company for expansion venture capital. So we can cross that off as well. And then C, mezzanine venture capital. This is going to be our word. And the key here is the bridge between expanding the company and the IPO. It's kind of just temporary debt that we're using before we go to IPO. And fun fact, the word mezzanine does have Latin roots meaning in the middle, which is what makes it synonymous here with bridge. So we'll go with C. Question 72. Which of the following will most likely decrease the value of a European put option? So on European put options, decreasing the value, this is typically going to be if the underlying asset is increasing, that's going to be one thing that'll make the value decrease, or there's the time component. So as we get closer to maturity or volatility decreases, that'll also decrease. So that's a couple things to think about going into this. A, lower carrying cost than previously observed in the market. So I'm going to pull in the forward price formula to look at this one. So the forward price is going to be a function of the spot price multiplied by our continuously compounding variable. And that's going to be raised to R, which will be our discount rate, plus U, which is going to be our carrying cost. So that's what we're looking at for A here, minus convenience yield. So that's any dividends or things you get for kind of holding that underlying for the period. So this U here, we can see it's a positive metric. So when this increases, that's going to increase our forward price. When this decreases, which is in this case, it's going to decrease our forward price. So like we said at the outset, if our put option is dependent on this forward price, if that forward price is decreasing, which would happen in the case of lower carrying costs, that's going to lead to an increase in the value of the put option. So we can go ahead and rule out A, since that'll increase. B, higher volatility than previously observed in the market. This will increase the value of the put option. Options are directly correlated with volatility. So if volatility increases, the option is going to increase, and that goes for calls or puts. And that's basically just because if there's more volatility, there ends up being more likelihood that the option will be in the money. C, higher risk-free rates than previously observed in the markets. That is going to be our answer, and we can look at put-call parity to kind of show this. So we've got the, let me move this over to the other side. So a put is going to be equal to a call option plus the risk-free bond minus the underlying. So looking at the risk-free rate involved here, so we've got R here. So if the risk-free rate increases, that's going to make our strike price, our whole bond value, it's going to decrease the value of that bond. So if this decreases, that's also going to decrease the value of the put option. Since this is a positive value, those are directly related. So we can kind of demonstrate through put call parity why higher risk-free rates would lead to a decrease in the value of the put option. Answer C. Question 73. Leslie Hauer is a junior trader at a derivatives dealer firm. During her first week following appointment, Hauer attempts to sell a risk-free bond using call and put options synthetically. She purchases call, and put options with the same exercise price and time to maturity. She simultaneously buys the underlying. With respect to her attempts in creating a synthetic short position in a risk-free bond, she is most accurate regarding her decision too. So the best way to look at this, I think, is through the lens of put-call parity again. So let's pull in that formula. So our risk-free bond is going to be this whole variable here, so the x discounted back by 1 plus r to the t. So what we want to do is, if we're going to be short here, we want to get that to a negative value in this formula. So we would move this over here by subtracting this whole variable to the other side. And then we would subtract s and p from that side in order to isolate this variable. So to be short here, now we have all of our variables on the other side. So we've got the call option, the underlying, and the put option. So we're going to be positive. We're going to be long the call because it's a plus sign here. And then we're going to be short the underlying. And then we're going to be also short a put. So we'll be buying a call, shorting the underlying, and shorting a put as well. So we look at those. We've got buying the underlying. We want to be short, so we can cross that off. Purchase call option. Yes, that's what we want since we're long here. And then we're short the puts, not purchasing the puts. So we go with answer B. Question 74. In contrast to interest rate options, forward rate agreements A, impose obligations on counterparties. So this would be correct. Forward rate agreements are obligations. You are required to do what the agreement says, whether that's deliver the underlying or pay some currency rate or whatever it is. So that would be correct. And in contrast to options, which are going to be the right but not the obligation. B, are contracts with an interest rate as the underlying. We can rule that out since they both could have an interest rate as the underlying. We could have interest rate options, or for forward rate agreements could be based on interest rates. C, are offered for purchase and sale by different dealers. This is also a trait they both share. So we will stick with A, impose obligations on the counterparties. Question 75. A key risk for investing in alternative investments includes A, limited redemption availability. This sounds like it could be our answer. Illiquidity is typically a feature of alternative investments, so there will be limited time frames or certain times of the year potentially where you'll be able to have redemption. So I think we can probably go with A, but let's make sure we can rule out B and C. B, concentrated portfolio positions. This can be a risk. But it can also be a risk of traditional investments, so it's not necessarily a feature of alternatives specifically. So I would lean towards sticking with A related to B. And then C, reduced diversification potential. That it could end up being a risk if you're fully invested in public equities and then also private equity. But typically, alternatives are used to reduce diversification or to provide diversification potential. So we can rule that out as well. And we'll stick with A, that illiquidity or limited redemption is a key risk. Question 76. A drawback of investing in funds of hedge funds most likely includes A, diluted returns. This could definitely be our answer. I'm going to circle it for now. Returns end up getting diluted in funds of hedge funds because there's multiple layers of fees. So the fund of funds itself is going to charge the investor 1% management and then 10% incentive fee typically. But then on top of that, they're investing in a bunch of hedge funds that are charging them 2 and 20. So there's multiple layers of very large fees, which can really dilute your kind of net returns. B, longer lockup periods. This is going to be incorrect relative to investing in the actual underlying hedge funds. You can typically have shorter lockup periods with the fund to fund than if you're directly investing. And then C, difficulty in conducting due diligence. It's actually a little easier since the fund to funds are going to have very extensive teams and expertise doing due diligence on those underlying hedge funds, so your due diligence is more focused on just the fund to fund. So we'll stick with A, diluted returns. Question 77. Garcia Miguel is comparing the valuation of 3 private equity companies for investment using the discounted cash flow approach. She has collected cash flow data for the 3 companies and would like to invest in the one with the highest valuation. So we've got company A, B, and C, and we've got their cash flows and their cost of equity. All cash flow forecasts are perpetual. Miguel should most likely invest in company A, B, or C. So when our cash flows are perpetual, essentially what we do is we're going to take our free cash flow to equity, and then we're going to divide it by the cost of equity. And we want to invest in the one with the highest valuation. So we'll just take these 3, do that math, and then invest in the one with the highest valuation. So here's what that ends up looking like. For A, we're going to do 40,000 divided by 0.05. B is the 155 divided by 0.12. And then for C, we've got 88,100 divided by 0.06. And we can see our highest value is going to be C. So we'll go with C. Question 78. An analyst is calculating the 1-year price of a commodity futures contract with the following characteristics. So we've got spot price, convenience yield at the end of 1 year, and then storage costs at the end of 1 year. So as a reminder, convenience yield is going to be a benefit for holding that underlying. This is something you're going to be receiving. And then the storage cost is going to be a cost of whoever's holding that underlying. If the risk-free rate is 5%, then the future price of a 1-year commodity future contract is closest to. So the formula we're going to be using here is pretty straightforward. So we're going to be taking spot and then multiplying that by 1 plus the risk-free rate. And since we're doing a 1-year contract, it makes it a little more straightforward. If we were doing a half year or longer, then we would need to obviously compound or reduce this risk-free rate. And then we add the storage cost to that to include that in the futures price, and then subtract out convenience yield. And so we do that out, and what that ends up looking like is basically we're given all these variables, so we just need to plug them into the formula. So we've got 80.96, and then we're going to multiply that by the 5% risk-free rate. And then we add in that storage cost of 7.8, subtract out 5.5 convenience yield, and we get 87.3080, which we can round up to 31 cents. So we'll go with A. Question 79. Mark Taylor is an equity investor who recently purchased the stock of a Kenyan enterprise. The risk-free rate of return in Kenya is 4.5%, while the expected return on the market index is 7.2%. The correlation of the stocks purchased with the market index has recently increased from 0.6 to 0.8, and the standard deviation of the stock and market index is 25.7% and 16.4% respectively. The expected return on the Kenyan stock is closest to. So we're going to be using CAPM for this, and we're given risk-free rate here, and we're given the return on the market index. So we have our risk premium and risk-free rate. However, the tricky part here is we're not given the beta. We're given the correlations. And we're told that it's recently increased, and then we also have the standard deviations. So we can use these standard deviations and the beta of 0.8 in order to calculate that expected return on the stock using CAPM. So I'm going to pull in our order of operations here. So like I said, we've got CAPM, we're calculating expected return, we're given risk-free rate, and the equity risk premium will just be that 7.2 minus 4.5. But we need to solve for beta. So beta is going to equal correlation times the standard deviation of the asset, which we're given at 25.7. And then we're going to divide that by the standard deviation of the market, which is going to be 16.4, which is given to us. And then from here, we get a beta of 1.2537. So then it's a little simpler now. We're just going to plug this all right here into the formula, into the CAPM formula. So we get 0.045 plus 1.2537 times the equity risk premium, which will be our market index expected return, minus the risk-free rate. And that comes out to 0.0788, which corresponds to answer B, 7.88%. Question 80. Maya Thomas is an independent equity investor who has undertaken investment in a Brazilian coffee manufacturer stock. The covariance of the manufacturer's stock with the market index is 0.01577 and the market variance is 0.01360. Thomas can most likely anticipate earning a return on her equity investment that is A, less than the risk-free rate, B, less than the market return, or C, greater than the market return. To determine this, we're given the covariance of the market index and then the market variance. So with these variables, we're going to be looking at beta to determine what our expected return is. So our beta is going to be covariance with the market, which we're given, divided by market variance. So that gives us a beta of 1.15956. So this is telling us that our stock of this Brazilian coffee manufacturer is going to be more have a higher standard deviation and be more volatile than the market. And the only reason we would accept a higher standard deviation and higher volatility is if we were also expecting a higher return. So if we have higher risk, that means we're expecting a higher return. So we could conclude that C is our answer, greater return than the market.